In October 1973, the world experienced a monumental shift in its economic and geopolitical landscape. The OPEC oil price shock, a dramatic spike in oil prices, not only disrupted economies worldwide, but also fundamentally changed the way we think about energy, politics, and global power. To understand the significance of the 1973 oil price shock, it's important to first grasp the global energy landscape of the early 1970s. By this time, oil had become the lifeblood of modern economies, powering everything from transportation to manufacturing. For most of the 20th century, the United States and other Western powers had easy access to abundant, cheap oil, especially from the Middle East. The world was heavily reliant on OPEC, but many countries took oil supplies for granted. In fact, at the time, OPEC was a relatively weak organization compared to the global oil giants like Standard Oil and Royal Dutch Shell. OPEC, which had been founded in 1960, was made up of 5 countries: Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. But in the early years, their influence over global oil prices was minimal. The Western world controlled the vast majority of oil production and distribution. However, by the late 1960s and early 1970s, geopolitical tensions in the Middle East began to rise. Several factors converged, setting the stage for the 1973 oil crisis. The key factor was the increasing oil nationalism in OPEC member countries. Many of the countries in the Middle East felt that their natural resources were being exploited by Western oil companies, and they began to demand more control over their oil. By 1973, several OPEC countries had already begun to nationalize their oil industries, taking control from Western oil corporations. This shift gave OPEC more influence over global oil production. Then, in October 1973, the Middle East was thrown into turmoil. The Yom Kippur War broke out between Israel and a coalition of Arab states, including Egypt and Syria. The war, though a military conflict, would soon escalate into an economic battle with long-lasting global consequences. The United States, along with Western allies, supported Israel. In retaliation, the Arab members of OPEC, led by Saudi Arabia, launched a bold and unprecedented action. They announced an oil embargo targeting the United States and other nations that supported Israel in the conflict. But the embargo was just one part of a larger, more strategic move. OPEC also agreed to cut oil production by 5% each month, which further tightened global oil supplies. The immediate impact was devastating. The price of oil skyrocketed from around $3 per barrel to $12 per barrel by the end of 1974. In just a few months, the price had quadrupled. In the United States and Europe, gas stations ran dry as people rushed to fill up. Rationing began, and in some areas even numbered and odd-numbered license plates were given alternating days to buy fuel. But it wasn't just about inconvenience. The rise in oil prices had severe ripple effects across the global economy. The cost of transportation, goods and services soared. Countries dependent on oil imports, including the United States, Japan, and Western Europe, found themselves facing a double blow: high oil prices and an increasingly volatile global economy. The 1973 oil price shock did more than just raise fuel costs. It led to inflation across the world. In the United States, inflation rates surged while unemployment began to climb. Economic growth stalled, and the country fell into what would be known as stagflation, a combination of stagnation and inflation. President Richard Nixon responded by imposing wage and price controls to combat inflation, but this proved to be only a temporary solution. The American public began to feel the consequences of relying so heavily on foreign oil. The crisis also exposed vulnerabilities in Western economies, which were overly dependent on energy imports. In an effort to conserve fuel, Nixon introduced the first-ever national speed limit of 55 miles per hour, which became a symbol of the broader energy-saving movement in the U.S. The 1973 oil shock was more than just an economic event. It marked a fundamental shift in global power dynamics. For the first time, OPEC had shown the world that oil wasn't just a commodity, it was a powerful geopolitical tool. The embargo and production cuts were a calculated demonstration of the organization's ability to control oil prices and, by extension, influence global economies. Saudi Arabia, in particular, emerged as the dominant force within OPEC. The country's vast oil reserves gave it immense leverage, and it was now the key player in the energy market. The West could no longer dictate oil prices or terms. The balance of power had shifted, and the economic world would never be the same. Though the embargo was lifted in 1974, the effects of the oil shock lingered for years. Prices remained high, and many countries began to look for alternatives to oil. The crisis sparked efforts to diversify energy sources, including the development of nuclear power, solar energy, and wind power. Countries began to invest in energy efficiency and conservation. In the United States, the government established the Strategic Petroleum Reserve to stockpile oil, providing a buffer against future disruptions. The legacy of the 1973 oil crisis also changed the way governments and businesses planned for energy security. The oil market would never again be seen as a simple supply and demand equation. The 1973 OPEC oil price shock was a defining moment in modern history. It reshaped the global world. For more updates, do subscribe to Fellow Investors.